there's a ton of 1% risks, right? You can never eliminate the fraud, Ponzi scheme, mismanagement. Those are all what I call 1% risk, and they can happen. I don't think I've heard anybody on stage anywhere at the conferences or on podcasts mention the word crash. And we've had an actual crash in asset prices on the non-institutional side across pretty much most or all asset classes because of the increase in interest rates.
There are like 3 or 4 sections that you would focus on when you're looking at the PPM?
So there's the cash call provisions, there's the reporting requirements, there's the indemnification clauses, there's a cash distribution requirement. I do background checks on every single sponsor, all the managing members of a manager entity. There's an inverse relationship between the number of deals someone did in 2021, 22, 23, and 24, or well, let's say 23, and the likelihood that I'll invest with them. As I mentioned before, I have 100% black and white requirement for doing background checks on sponsors, and I gather that's not the case for most LPs. But so I think one thing that I think that a lot of the LPs kind of underestimate or don't pay enough attention to is.
Can you bring us up to date, maybe from both? Maybe start with the macro, where you think we are, again, from an LP perspective and how that affects your investment decisions, but then also dig into where we are sort of in the syndication world as well.
Yeah. So I think one thing that I think that a lot of the LPs kind of underestimate or don't pay enough attention to is the macro and also thinking ahead. So one thing I mentioned before, I invest in a very specific box. And one of my very important points in my box, I'm typically looking for a longer term fixed rate loan because I invest for more predictable cash flow. I like to have that for a longer term. So I'm typically targeting a 7 to 10 year type of horizon. I didn't invest in any of the floating rate bridge loan apartment deals, for example. But because of that, I'm mentioning all this because I have to think way ahead in terms of consumer trends. You know, if I invest in a property today and it's going to resell in 10 years, is that still going to be in demand? If I'm investing in an apartment building, you know, in 1990 and it has 8-foot ceilings, and then in 2000, all of a sudden everyone wants 9-foot ceilings, and that's what's being built, and now that's like a structural obsolescence. Is that going to be in as much demand? Is that going to affect the value? That's just one minor example, but I'm talking about consumer trends. Just looking for more, where is there going to be predictable demand for an asset class? So that's something I pay a lot of attention to. Right now, my general opinion about the economy is that I think there's a very high probability. I try to be as objective as possible, just looking at the numbers, the data, and not looking at the media. And I think there's a very high probability of a recession coming up. I couldn't tell you when or how bad it's going to be. But because of that, I have to operate very defensively. And that's what I'm doing right now. I'm mostly on the sidelines, except for very unique situations. With regards to syndication and you know, the LP world, it's amazing. Like if I had to pick the most important year for me to be on top of that, it would probably be this year compared since 2009, for example. And what I mean by that is, number one, if I'm going to look to invest with an operator going forward right now, I have to pay very particular attention to are they dealing with any distress? Are they going to have a foreclosure? Did they just have a foreclosure? Because I don't know, for those of you who aren't familiar, my experience in the previous cycle was that if a sponsor had just one foreclosure, then they would have a higher interest rate getting any of their new loans going forward for X amount of years. And that means that I would be taking on lower return for the same amount of risk as an investor. And so that means I'm going to pass on any of those scenarios, most likely, if I can figure those out in advance with any sponsors going forward at the moment, right? Unfortunately. And so I've got to be very careful with that. Obviously, there's a lot of carnage going on. Unfortunately, like it's very interesting, actually, Mauricio. Like I don't think I've heard anybody on stage anywhere at the conferences or on podcasts mention the word crash. And we've had an actual crash in asset prices on the non-institutional side across pretty much most or all asset classes because of the increase in interest rates. And I try to use that word as often as possible to really make people understand, like, what is the current status? I mean, we've had a crash. Most of the assets are down on the non-institutional side between 20 and 35%, right? That's just a fact. And that's the definition of a crash on the stock market side, typically 20% or more. And so with that, I've got to be very, very careful navigating the landscape. If I'm going to look at a deal today, it has to be in a position where I think it'll actually, for some reason, have so much padding at the moment that it will get through a recession and potential reduction in either NOI or value or both. And I am very concerned about going into deal today versus waiting. One more thing I'll add is that real estate moves very slowly. So I would personally rather be too late than too early in terms of, and you know, I noticed that very, very distinctly in the last recession. You want to be too late versus too early. You know, stock market goes very quickly. Sometimes better to be too early than too late. It's the exact opposite with real estate. I don't want to catch a falling knife. I saw people do that in 2009, and some of them really got burned. And so I rather just kind of wait it out a little bit and optimize for how I'm buying. And keep in mind, again, that with the profile I have to buy it right, because sometimes there's no value add or little value add being added to what I'm buying. So I have to buy it right. That's very important.
Yeah, thanks. And Paul had a question, and guys, if you have questions in there, please drop them in the chat, because as you guys know, this is for you guys and making sure we get your questions answered. But Paul was asking, you talked about foreclosures, Jeremy. Where do you look for to find out if the seller has gone through a foreclosure before? Because Paula says they will likely not tell you. I would tell you that should be in the PPM and disclosed. But do you have an independent verification method?
Yeah, look, to be honest with you, I don't have one at the moment. I'm probably going to figure that out because it's still too early from my perspective, right? I'm not jumping into a deal today because of timing. I think it's still too early. So I don't have a good answer for you. I will say that generally speaking, if it's a reasonably well-known sponsor, I can ask around to other LPs and even investor groups and probably get a decent answer or somewhat highly confident answer. I also, I do background checks on every single sponsor, all the managing members of a manager entity, each one. And I don't know if it's going to show personally or not, because I honestly, this software it's not the same software I was using back in 2009. And so I'll have to see what happens there. But personal foreclosures end up there. They don't get removed after 7 years. So there's a chance I'll see it on there as well. Of course, I'm going to ask the sponsors and see what they say. But I'm going to do a ton of digging for sure. And one of the criteria I'm going to have in looking for sponsors to invest with for this next cycle, if and when it resets, is, there's an inverse relationship between the number of deals someone did in 2021, 22, 23, and 24, or let's say 23, and the likelihood that I'll invest with them. And that's because my optimal sponsor stopped buying properties in 2018 or 19 and just waited because we were kind of end of cycle timing in 17, 18, 19. And I actually know some sponsors who do this. And then in 2021, 22, it was just craziness. And there was too much risk associated with buying at that time. And so the really conservative sponsors, that I'm looking for in many cases may have not bought anything for 5, 6, 7 years already. And that's the optimal sponsor for me. And therefore, I probably wouldn't be dealing with that unless there's some other unusual circumstance.
Speaking of sponsors, Jeremy, you want to give me a percentage, sponsor versus the deal? What's the weighting on that? How much more important or less important is the sponsor versus the actual deal you're analyzing?
Well, what I tell people is sponsors definitely number one, who I'm making a bet on because I'm giving control to someone, right? So that's definitely number one. The deal is a close second. If I have to be, if you put a gun to my head for a weighting, I'd probably say like 55-45. I think the deal is almost as important, because if it doesn't fit in my box and I can't get 100% comfortable with the criteria, the business plan, and the numbers, it's not going to make any sense for me. I mean, once I'm giving someone control, I better be able to sleep well at night, right? Because I chose, at least in my mind, right, from a probability perspective.
Yeah, speaking of control, Jeremy, that's one of my initial questions was, why did you ultimately decide to do LP investing versus being, active? I mean, what's the benefit for you of just being because you are literally purely an LP guy. You don't syndicate yourself. You don't buy stuff yourself. You literally do the due diligence, write a check, and go home.
Yes. So when I started, it was almost forced because I was working at Disney headquarters at the time and I was crazy busy with the work. So there was no way I could really do this effectively on nights and weekends and really buy stuff. In my opinion, really, I'm a very detailed guy, so it just wouldn't have worked. And then once I left the corporate, I had more time. It's pretty clear that had I been more active, I probably would have made a lot more money. But I really like being passive. And I actually don't like the idea of having to do all the minutia. And frankly, to be honest, I would have had to start from scratch after all those years, because I have if you have me the keys to an apartment building or an office building or whatever it is, I have no clue how to run it. I couldn't tell you the first thing of who to pay what taxes and when, and I mean, literally no clue. And it doesn't sound appealing to me. So I just went with what I thought I was going to like. And that's why I haven't changed. I like what I'm doing, and I'm just, don't think it needs to change.
What specific criteria do you have when you're evaluating an LP position or an investment?
So you're talking about overall, or you're talking about actual?
If I had a deal, so if look, there's 45 sponsors on here, and they all have deals, and so if they all sent you a package tonight and say, Jeremy, invest in my deal, what are you looking for? What's your criteria?
Yeah, I'm going to put aside like the asset specific criteria. I'm just going to give you some quick examples. Like, for example, for apartment buildings, I like to be over 100 units because I like tenant diversification. For mobile home parks, I get comfortable over 75, preferably over 100 lots. for self-storage to get comfortable over 300, but preferably over 800 units, storage units. So, it depends on the asset class, right? The first thing I'm going to do if somebody sends me a stabilized property today and then let's assume it's an area I'm comfortable with. I tend to stay away from highly volatile areas and high priced areas with low cash flow, like Los Angeles, New York, and all those locations. So you send me a deal today, it's in the right location, right? The first thing I do is look for positive leverage. If I had to point at one thing right now that kept me out of doing deals for a whole number of years right now, for the most part, and is still, in my opinion, keeping me out of trouble until, in terms of me being too early, it's the positive leverage. And if you look historically, as an LP investor, in my opinion, and looking at deals, or any investor, I think you should be able to get 150 to 200 basis points of positive leverage, which may sound crazy to some of you, considering in the last few years there was negative leverage. Some deals I'm seeing today are still negative leverage. Some of them are minor positive leverage. If your deal has 50 basis points of positive leverage, negative 50 basis points of negative leverage, all that, it's not something I'm going to consider because I'm going to wait. Because if you're looking for a proper full reset, that's where we're supposed to get to. And I operate very in theoreticals, right? So I could be wrong, of course, right? But this is just all probability perspective and what I think I should be doing to protect myself. And so that'll be the first thing for sure.
And Jeremy,
Mauricio,
before you go on to the second thing, you want to kind of just go a little bit higher level and explain what you mean by positive leverage versus negative leverage?
Yeah, sure. So positive leverage is a concept that the cap rate that you're buying it at, the in-place cap rate, is actually higher than the interest rate on the loan, assuming it's a fixed rate loan. So let's say you're buying something at a 6 cap rate and the interest rate's 4.5, you have 150 basis points of positive leverage. And that's that 150 to 200 basis points of positive leverage I meant that I mentioned I was targeting. What's been happening the past few years is that more commonly, you would see a deal that was a 4 cap with a 5% interest rate. And that's negative 100 basis points or negative 1% positive, negative leverage. And that is, and the challenge with negative leverage and positive leverage is that theoretically with positive leverage, if you're buying something and levering it with a loan, it should be accretive, meaning that you should be able to get a return for the risk of taking on the loan, right? And taking on the debt. But it's been negative leverage instead. And I understand a lot of those deals pencil from a value add perspective. So it's a different business plan than what I focus on. But from what I focus on in stabilized stuff, I'm looking for positive leverage.
Cool. Thanks for that. So that was the first you were about to, before I interrupted you, you were going to go back to a sort of another criteria that you look at.
Yeah. Well, so this is going to go into a long answer, but the bottom line is I'm looking for someone who's conservative. So the next thing I'm going to do, if it actually meets the positive leverage criteria, I'm going to look at the projected cash flows. And if they're not hitting a certain range, that's probably not going to work. After that, if it actually is hitting a decent range, then I'm going to jump into the actual pro forma and start to try to figure out, okay, what was the revenue, inflation assumptions? What are the expense inflation assumptions? What is the exit cap assumption? And start to just look for hints of, is a sponsor conservative or not, right? Because I'm trying to match my own personality of being conservative with a conservative sponsor. Then I'm going to obviously read through the business plan, understand even what's being accomplished here, like what is the purpose of purchasing the property and what is the business plan associated with it. And by the way, of course, I've never invested in a development deal in my 22 years. So automatically, if you send me a development deal, that wouldn't be a fit for me. If it's a heavy value add deal, especially at this timing, that wouldn't be a fit for me. And anyway, and then I'm going to just dig deeper. I mean, we can go across many steps, but I'm going to dig deeper from there.
It's funny. I was going to, I don't know, it's a few months ago. I think Oleski, right? He's a big LP guy.
Yeah, for sure.
He came up with these 15 reasons, and I want to go through 15 mistakes that LPs make or should be looking at. And I'm not going to go through all of them, but I thought some of them were interesting. I wanted to get your take on it. Maybe give me agree or disagree, and then maybe dig in a little bit. But one of the things he said is any syndicated deal that has lower than a 65% split for LPs, like a 65-35, anything lower than that, he's out. Do you agree or disagree with that?
I disagree with that as a hard rule. I agree with that if it's a relatively new or medium experienced sponsor. I have invested with some highly experienced sponsors. I'll give you some examples. I invested with the 5th largest owners of mobile home parks in the US who were non-institutional. And I took a 50-50 split on a 10 pref, which kind of the 10 pref helped to make up for it. but I made that trade-off because of their level of experience and because they had very unusual access to a network of properties that pretty much nobody else had. I can get into more detail, but so I think that there are some exceptions to be made. But to his point, I think his main point, though, to be fair, is that you need to get a fair split as an LP in order to be sure that you're getting the correct risk reward type of scenario. And I think that's what he's trying to address with that.
And when we were on the next one's about a pref. And so we had a nice lively discussion when we were on stage at Best Ever about pref and whether they were a good thing, a bad thing, and your thoughts. He was saying anything lower than a 6% pref would be problematic. But can you give me your overall thesis or philosophy on the preferred return? Is that important to you? Is it not important?
Sure.
Give me your 2 cents on that.
Well, let me just start by saying that it's very hard to make a hard rule of pref. I don't believe in such thing as a hard, because I think that has to do with actual cap rates and cash flows and interest rates. So right now, my hard rule for myself is under 7 pref, it won't work, but that could change. So I'm not saying his is wrong necessarily, in that I just don't think you can pick one and say this is going to work for 10 years. It just that's dynamic. So as far as pref goes, I have a very firm black and white policy with pref. I don't think I've ever invested in a deal that didn't have a pref. I maybe have made an exception to. I don't want to say for sure, but I can't recall of making one. The pref for me is not probably what most of you think. I'm not looking for a minimum return that I think I should be getting before the sponsor gets a split, even though I do believe in that. That's not the number one concern. The number one concern for me is a downside risk protection. If the deal is not performing to projections and I'm not getting that cash flow that was projected to get, because I live off the cash flow, so it's crucial to me. That's what I focus on. I want to know that I'm going to be made up for, in the future, for the fact that I didn't get that full cash flow because I depend on that cash flow. And so for me, it's a downside risk mitigation as opposed to trying to hit a certain minimum return. I suspect a lot of LPs are just looking at the pref saying, I want to hit this minimum return. That's what I think is fair. That's not my number one priority there.
Cool. What about acquisition fees? Do you have any hard rule? I think Alesky said something to the effect of anything above a 3% acquisition fee he had a problem with. You agree with that?
I do agree with that. And I actually would say that that's my limit of comfort. But for that, in my opinion, it's got to be either some unusually small deal where, because, it's absolute dollars. So if you're buying something at $100 and you're getting a 3% acquisition fee, then obviously that could be a much bigger acquisition fee, right? And obviously that's a very bad example. But the point is that, like, as the deal gets bigger, the acquisition fee typically comes down. That's one thing to look for. Another thing too is I'll give a little tolerance for a more experienced sponsor to take a little bit more acquisition fee, so I get in the door there and actually leverage their experience. Because in my opinion, these trade-offs I'm willing to make with more experienced sponsor is that I am benefiting from their experience. And in exchange, my risk of not hitting a return is lower theoretically with a more experienced sponsor due to learning. So I am willing to give a little more in those scenarios.
Can you talk about that a little bit, Jeremy? Because this has been something that's kind of bugged me a little bit, because I do a little LP investing myself. And that is the difference between the returns you're getting from an experienced syndicator who's been doing this for a while, who's got a great track record, versus somebody brand new.
Yeah.
It seemed to me that a lot of those returns were all basically the same. They're all 2%, asset management fee, and then maybe an 80-20 split or a 75-25 split. And I always went to, like, wait a minute, if I'm getting about the same return, why wouldn't I go to a more experienced syndicator who's proven themselves over 20, 30 years versus going with a more inexperienced one? To me, if you're inexperienced, I'd be getting a little bit better cut because I'm taking a little bit higher risk. What do you say about the difference between an experienced and an inexperienced when it comes to the waterfall and the returns?
Yeah, honestly, I have on average seen in my experience that returns, the splits and the fees and stuff are better with someone who's less experienced versus someone who's more experienced, who typically can command more splits for themselves and potentially more fees. So I mean, I've never plotted on a chart, but I think if I did, I think there'd be a very, very strong correlation between those two. And by the way, I fully agree with you. I remember specifically mobile home parks, man, in the 2015 era, a lot of new people jumped in and they were literally mirroring what I would call, the guys who I invested with, just put a flag in the sand of, like, their 50-50, 10 pref 50-50 split. I saw people copying and pasting that. And I literally said to them, like, you're not these guys. Like, you haven't done this for 20 or 30 years. You can't get these splits. This isn't a fair split. And I actually saw some people had to change, like, actually on the fly, their splits, like in their PPM or whatever. I don't know how that's done even, Mauricio, so maybe you could tell us, but where, like, they aren't raising the money because they're getting the pushbacks, and now they go create more favorable terms and switch it more favorable for everybody. So yeah, that's something but that's a correlation that I do see for sure.
Let's talk about, I think you've kind of answered this, but maybe you can package it into like maybe a nice little comprehensive response. How do you manage risk in general terms? Is it through that due diligence period with the sponsors, or is there anything specific that you're doing to manage your risk?
Well, there's a lot of things I do to manage risk. I would say, if you honestly back up, the most important thing I do to manage my risk is stay on top of the economic data. Literally, if I had to pick one thing, and I personally read about 2 to 3+ hours a day. Those are real numbers. Those are really, I do between the morning and night. What's going on in the economy, the data, what the general consumer sentiment is, et cetera. That's the biggest risk mitigator that I do. And that's actually how I managed to avoid 2005 to 2008 period of non-investing in single family. And that's how I just avoided essentially missing the end of the cycle. It's the exact same thing. And so, so that's number one. Number two is, obviously you have to vet the sponsor as well as possible. Two key pieces of risk mitigation I do there, because there's many things, but number one is, as I mentioned before, I have 100% black and white requirement for doing background checks on sponsors. And I gather that's not the case for most LPs, but which is unfortunate. And I've definitely been saved several times because of that. Number two is I don't think I've ever invested with someone without meeting them first in person. Again, there could be an odd exception, but I like to meet someone in person and get a gut feel for them before I invest with them, because I have learned that the in-person gut check can go the exact different way that you were expecting. I've been on an airplane flying with somebody thinking I'm not going to invest with them, but I'm going to do it anyway because I like the deal. And by the time I'm done, I actually invested, and vice versa, just from a gut check. I think that's very, very important to do in person.
Would you knock anybody who doesn't do this full time and has a W-2 job?
You said
would you not invest in someone if this was if they weren't doing this full time and they had a side, they had a W-2 as well?
Oh yeah, you're talking about a syndicator sponsor?
Yeah, if the syndicator has a W-2 job and this is something that they're trying to work towards, is that an automatic hard no? Or
the reason why it would be a hard no for me is because I have a minimum requirement of experience in terms of deals that have been purchased. And I picked this out of thin air, but to me, if you don't have 7 to 10 deals that you've actually acquired, I'm not going to be very comfortable I'll maybe watch you if I have a good gut feel for who you are and what I think is going to happen with you, and I'll end up on your list to watch. But, and I think that by the time someone's acquired that level of deals, they're not a W-2 anymore. And in my opinion, honestly, they shouldn't be if they have that many deals already. It's a lot to manage.
Cool. Matt asks, what's included in your background check?
So I don't know if they're asking what I have to get from the sponsor or what I see in the results.
I guess start at the beginning. What exactly are you doing? Are you pulling a national database report, sort of a standard? Do you just pay for a report and just then read it, or how are you doing the background checks?
Yeah, so I use a company called TLO, which is owned by TransUnion. There's another very big one. There's a couple of big ones. Another one is Accurant, which is owned by LexisNexis. I mean, TLO is a database that I actually, friends of our family, one of my friends is a retired police lieutenant in LA. And when I told him I was using TLO, he literally said to me, like, this is when he's not retired. He said, when I bring someone in and book them, I actually look at TLO, a database first before I actually run our own internal database because it's more comprehensive. So if I run a report on myself, I literally get, and I mean, I've never had nothing, right? Not even a speeding ticket in the US. I'm from Canada originally. I get I think probably a 20 to 40 page report with all kinds of crazy stuff. And so you see a ton of stuff, but basically the basics of what I'm looking for in that report are liens, judgments, any court cases, any potential court cases, any tax liens, like I mentioned, just trying to assess, who are you? What do you own? Actually shows all your property ownership. It shows your business ownership. Sometimes I just confirm, is someone in the right address? You want to confirm as much as possible. And there's just tons and tons of data.
All right, Jeremy, LPs are pissed. Let's move to that topic. LPs are pissed. Chris, I'm going to go to your question because you'd asked it, and I've got a few that I came in before this, but when things don't go right, Jeremy, I mean, as an LP, what do you do? Is there anything you can do, or as the pun comes, do you just have to roll over and take it?
Yeah. So, and I'm sorry for anyone who's watching as an LP, this is not funny. I feel horrible at the moment for the GPs and the LPs, to be honest, really, really bad. I just wasn't expecting Mauricio to say that. So, I have a bit of a different approach than some LPs, I think, with this. So I am kind of like almost hyper diversified. I'm in over 60 different LLCs right now. Actively, I've been in over 150 to 200 plus. I don't know how many over time. So if I'm in a deal that's not going right, I'm like, okay, look, I'm not going to bat 1,000 over the course of 30 years. It's just not going to happen. It's not realistic when you're doing that many things. And so I will chalk it up to like, oh, this is why I'm diversified. And obviously, number one thing at that point is, what can I learn from it? That's the most important thing, right? And number two is, okay, we'll probably move on, right? And it depends on the scenario, but Mauricio, honestly, in most scenarios, because I'm investing in small chunks across a lot of things, as you know, as an attorney, often it does not make much sense to go and actually spend time or money pursuing. And in most cases, in most of these cases, it would be a scenario where I've already gotten some return of capital in a combination of cash flow, most likely, and or depreciation. And so when you factor in depreciation, often you end up, you don't realize maybe you've already gotten half or more of your capital back. And now you're talking about a very small amount of capital to try to recoup. And so we could talk about all types of scenarios I've seen over time, but my approach is very laid back. I'm passive for a reason. And if something doesn't go right, yeah, this is why I'm diversified.
Christina has an interesting question. It's more really kind of an ethical question, which you can get into or not. But is there something, I guess my angle before I ask this question is there anything that you do on the front end to kind of prevent something like this? But Christina's question is, if a deal's bleeding and the sponsor's already taken their significant acquisition fee, but they continue to take their asset management fee every month based on gross revenue, do you have a problem with that?
I do have a problem with that philosophically. So, I've been on both sides of the coin, where something's underperforming and you have a manager who is clearly just doing what's in their best interest. And, when times get tough, you really see their true colors. And sometimes you see their true colors are not the colors you want to see, but now you know who you're dealing with, never to invest with them again, right? But I more often than not see the other way around. I more often than not see sponsors providing loans or doing certain things and not taking fees to try to help the investors, because that's the right thing to do. And just similarly, I would say that, thankfully, like, you hardly ever see a real Ponzi scheme. You hardly ever see true fraud, right? These are really low risks. They do happen, and you have to be diversified out of them. So I would like to say that in the majority of cases, from what I've seen, the sponsors tend to do the right thing, but there's certainly times where it's obvious that they don't. And again, in the position, and as we go back to the same conversation we just had, Mauricio, at that point, it's like, it's not that my hands are fully tied, but is it worth going through all the trouble or not? In my opinion, most of the time it isn't.
Yeah, and I think you kind of answered this following question from Jeannie that asked it in the Facebook community. By the way, if you guys are not part of the Real Estate Syndicator community, I highly recommend joining. It's a Facebook group. A lot of you guys here are part of it. Very, very valuable, I think. Jeannie was asking, can I trust a syndicator who got caught in a variable rate issue due to an exponentially rising interest rate and then sold the property for a loss? Is that somebody that you would then sort of immediately rule out for the next deal, or is that something you just take a closer look at?
So I think that's, to be fair to the sponsor, I think that you really have to take a look at the circumstances. Now, to be honest with you, I'm not going to have much tolerance for that, but I do want to point out that I wouldn't have a completely black and white. I know a sponsor, I'm not going to name them, who has a very good reputation, who has done tremendous work for LPs, who I think did one floating rate deal this cycle, and they're going to get burned on it, but one, right? And so you look at that, you look at everything else they've done, they may be their one lesson, right? And I'd have to look at the business plan behind that too, to understand why they did that exactly at that timing. But, to me, if you see someone who's done multiple or many and has many distress or multiple, and it's just kind of their philosophy, it's not even a question. Like, I'm not trying to punish anybody. It's just that there isn't an alignment between their willingness to take on risk and my risk appetite for myself. That's actually that's the foundational problem for me with that. Right. That's why I point back to that sponsor who's done everything right from that perspective for me in terms of being aligned, except for that one deal. I'll take a look at what that circumstance was. So I wouldn't take a black and white, but then you have to go back to the fact that if they ended up foreclosed, you're going to get hit as an investor because of that on the interest rate. If they ended up doing a short sale or at a loss that you're referring to, and it wasn't a foreclosure, different situation. One thing I also have a lot of trouble with right now, but unfortunately it's happening, is that you're seeing sponsors who are in a very tough position, who are taking on pref equity. And because of cash call provisions that didn't protect the investors necessarily, or didn't have certain required steps, or maybe were not even defined at all, investors are waking up one morning and they're getting an email from a sponsor saying, hey, we just got this pref equity to step in and save the deal, but they don't even realize their common equity is pretty much wiped, right? And what you're essentially doing is saving the sponsor and not the deal, right? You're saving the sponsor from a foreclosure, you're saving a sponsor and their track record, but you're completely wiping out, if not mostly fully, the equity, the common equity investors. I have a pretty big problem with that if it wasn't offered to the common equity investors first, because I am seeing that, I'm hearing of that happening.
Yeah, let's talk about the cash call provision, because that's one of the questions I want to ask you about, specifically about the PPM, right? The private placement memorandum. Are there like 3 or 4 sections that you would focus on when you're looking at the PPM, or like is cash call? I think you said at some point cash call would be one of those provisions you would look at really carefully.
Just some obvious ones that are, very important to me right up front. So there's the cash call provisions, there's the reporting requirements, there's the indemnification clauses, there's the cash distribution requirements. There's a whole bunch of others too, but just those are the 4 immediate ones that always come to mind right away. Yeah, the cash call provisions, I have a very specific order I like people to go in, and I like it specified, because sometimes there's no definition at all for what happens at a cash call. And that's how you end up in a position as a common equity investor where you wake up one day and now there's pref equity ahead of you where you weren't even offered it, right? Because it wasn't legally required. So those are some of the important things I look at. There's a lot of, as you know, there's a lot of different important things.
Now just now more of a selfish question. Walk me through what your preference is on a cash call provision. Like, what's the pecking order that you like to see?
Yep. I prefer to see internal debt first so that I'm not getting diluted as an investor, then internal equity second. And what internal meaning, you go to investors, the current investors, right? Then internal equity, then external debt. So I'm still not I'm diluted by external people, and then external equity last, right? And if you have to follow that, then essentially you're going 4 steps until you're getting pref equity involved from the outside. But more importantly, you would have been offered external debt and then external equity as an investor, and you could have passed on it, but at least you had that chance before some pref equity group was brought in.
Awesome. And then I remember talking on the panel, talk a little bit about the reporting requirement, because that's one of the hot topics. I think one of the sources of frustration for a lot of LPs, because they're not getting the information that they are expecting. So I guess number one is, what type of reporting are you expecting, and number 2, what are you looking for in the PPM specifically as to reporting?
Yeah. So as far as what I'm expecting, so honestly, I place the blame on LPs in a lot of these circumstances only, and I'm just generalizing, but only because I find a lot of LPs don't ask for a sample report before they invest with a sponsor the first time. They just have like an expectation in their head of what they're going to get. And then they get their first report and then they're complaining about it. And then my question is, well, did you ask for a sample report? And they're like, no, okay, well, this is how the sponsor reports. This is what you're going to get. You may not be happy with it, but that's what you're going to get. So I think it's important for LPs to ask for a sample report, even if it has to be partially redacted, just to at least see what you should expect. So that's on the, what you should expect side. Personally, one thing that I look for is there's 2 different ways I see sponsors reporting on cash flow and kind of the results versus the projected. One is based off of the original projections, and the other is based off the budget for the year. Because to be fair, obviously, if you're 7 years into a deal and certain things have happened, especially with some asset classes more so than ours, like retail office, things can really change. Then often sometimes I'm getting a report based off of what's been budgeted just for that year, because they started that year in X position, right? But the problem is that I invested as an investor, not how that year was starting, but 7 years before, how those projections were made. So I strongly prefer to get the actuals versus the projected cash flow versus not the actuals versus the budgeted amount for that year. That's more fair to compare for the performance for this year for the sponsor, but it's more relevant for me to get the projections, the actuals versus what was originally projected, to see how much of a variance there is versus what I expected from the start. I hope that makes sense to everybody.
Yeah, you did. And you kind of flew by. A lot of people were asking about those 4 sections. So you talked about the 4 sections of the PPM. You talked about cash call provision was number 1. We talked about reporting. Did you say indemnification provisions as well? Talk a little bit about that.
Indemnification clause is one of the things I said. And then I also mentioned the the cash distribution requirements.
So talk about the indemnification piece, because I don't think that's something that most people pay too much attention to.
Yeah. So I believe the indemnification clause is important because from an LP perspective, when you hire Mauricio, he is representing the syndicator, and I'm on the other side of the table. He's not representing me, and he's not representing my best interests, even though I'm very good friends with him. basically I look to see for certain keywords I'm looking for. And I find that attorneys, and I've only looked at many of these over time, it's either fraud, willful misconduct, or mismanagement. And I look for all three if I can. Attorneys tend to get nervous, especially with mismanagement, because it's very nebulous, and anything that's nebulous can lead to interpretation in a court of law and can actually be beneficial for the defendant or the person, the plaintiff, and not their client, who would be the defendant in that case. But I'm looking for those three words if I can. If none of them are in there, that's a huge red flag to me, because that means that there could be fraud on behalf of the managing member, and then the company has to pay to defend the court case and the fees associated with the fraud. Same thing with the willful misconduct, same thing with the mismanagement. That's why I look for some of those terms. It's pretty important.
Yeah, just so we don't leave anybody behind, indemnification, to Jeremy's point, is like, if the sponsor's getting into hot water, whether it's a regulator, just imagine a regulator stops by and accuses the sponsor of doing something illegal or non-compliant, and then you guys or the company, and you're a member of the company, has to then pay for those defense costs and have to pay for any judgment that the SEC or state regulator. And so usually there's little carve out provisions that if you're doing something, if you do something fraudulent, obviously, or reckless is another term that we sometimes use, or grossly negligent. These are all different levels. At what point does the company have to indemnify and pay for defense costs and pay for penalties? And at what point does it not? And as you can imagine, you've just been defrauded. This person's been stealing from you, hypothetically here. And then suddenly the company is saddled with the bill of doing that defense, which doesn't make sense. Cool. And the last one, Jeremy, you mentioned was distributions. Is that right? Sort of the waterfall distributions. Yeah, let's talk about that.
It's not just the waterfall. Actually, what I'm focused on with that, and the waterfall is obviously important, but let's say that I invest with sponsor XYZ and they say to me, yeah, we make quarterly distributions. I'm like, okay, great. But I look at the deal documents and it says from time to time, the sponsor will, or the managing member or manager will make cash flow distributions from the available cash that they deem is available, after holding reserves. And, this is the typical language I'm just giving you. And that literally gives them carte blanche to make a distribution whenever they want legally. So if I don't get quarterly distributions, I actually had this happen to me once, okay? I invested in a smaller deal that was more of a friends and family deal. They were making quarterly distributions off of student housing. And it was actually a deal that was performing really well. But, the sponsor wakes up one morning, he's like, you know what, these are mostly my friends. I'm kind of tired of making quarterly distributions. I'm going to change it to semi-annual. And they just on the spot started doing semi-annual distributions. And it was actually in the operating agreement that they weren't allowed to do that, because I always check for that. I didn't push it because it seemed like, it was mostly their friends and that no one really had a problem with it. But the point is that it's very possible that that wouldn't have been in the operating agreement, and they would have been able to just wake up one morning and change it to every 2 years if they wanted to, right? So for someone who is very focused on cash flow like me, what I look for is that it's some type of verbiage like, within 60 days or 45 days of the close of the calendar quarter, the manager or managing member will distribute the available cash, minus whatever reserves, whatever it is that they deem to be available to distribute. So I'm looking for a specific timeline. And also what I like about that is that it holds the managing member to be accountable for a timeline. So that if I'm getting a distribution for a quarter 4 months later, right, instead of 2 months later, and I'm dependent on that cash, and I had that expectation of getting that cash, they're now breaching the operating agreement. I have that in my back pocket if I ever need it.
And you said something about, in terms of you're investing in like 50, I don't know how many you got going at this point, but Diane wants to know what's your systematic approach to tracking the performance of these investments on a regular basis? Yeah.
So I am not, I'm a one-man show. I have no assistant or anything like that. So I'm not quite as buttoned up as someone who had an actual company. But what I do operationally is that when I receive a quarterly distribution and a report, I'll compare what I was supposed to get in terms of the original projections to what I actually got for that quarter. And often the projections are annual, so I'll just divide it by 4, right? So let's say something's at 8% year one, I just divide by 4 to 2% per quarter. And if something's plus or minus 20%, I will not do anything about it. I'll just say, okay, this is within the range, because I'm not expecting to be exactly on, right? That would be crazy to expect to the penny, 7 years later. And so, but if something's above or below 20%, even above 20%, above the projections, I want to understand why. Like, I want to know why something's going really well or really badly, or, really well, really bad. Those are relative, right? If something was supposed to hit 8%, but now we have increased insurance costs increased expenses because of inflation, and now I'm hitting a 5.5 instead of an 8%, I already kind of understand what's going on potentially in something, right? But I do like to pay attention if there's a big enough variance, and I'll dig into it further and try and get more details from the sponsor if it's not already explained in the projections.
Chris has a great follow-up to what you said earlier. So when you see or don't see verbiage in the PPM or the operating agreement, do you have the power to redline those in the docs, or do you just basically, it's just a pass?
It depends on what it is. So, it's funny, we go back to these cash call requirements. So actually, I've seen crazy, challenging, or if not just very, very onerous cash call provisions. And there was a sponsor I wanted to invest with a few years ago who I remember, who was like up and coming. And I looked at the cash call provisions, and I was like, I talked to other investors about this. I said, did you see these? They're like, yeah. I just said to them, look, you got to change this to like something more reasonable. I'm not going to invest. They didn't, right? But sometimes what happens is that I'll point out a mistake or something that was their intention but isn't in there. So for example, sometimes I will approach a sponsor and say, hey, this from time to time, you can make any distributions you want at any timing. Can you just put it in there so that it's 60 days? They're like, oh yeah, we make those within 30 days. I'll just put it for 60 days, no problem. I thought it was in there. Like, I honestly, I hear that term a lot, Mauricio. Like, I thought that was in there because that's what they do, right? That's what they probably intended to have in there anyway. But a lot of the sponsors don't read every single word, right? And so sometimes you get a sponsor who is willing to put a whole bunch of things in because they're like, yeah, that should be in there because that's what we do anyway.
Yeah, I think Greg has a similar question. What do you do when you see things that are contrary to what you prefer? So you bring it up. I mean, the challenge with bringing it up depends at what point, but I mean, if it's a material change, obviously, then there's an obligation for the sponsor to have to go back to all the prior investors and get them to re-sign all the docs.
Yep.
Which, again,
I've seen like very critical errors where, for example, Waterfall, it was misworded by accident. Oh. And they went in and they created an addendum, and they then got everybody to sign off on it because they were in a bit of a bind. There was like sometimes I've actually seen literally somehow the PPM and the operating agreement did not say the exact same thing. And they were literally confounding, and there had to be an addendum. So there are certain circumstances where they just have to get it done. It's or otherwise they got a big problem.
Yeah, 100%. That's actually one of my big sort of red flags that I encourage LPs to look at, is just comparing the PPM to the operating agreement. Make sure they match, because if they don't, the operating agreement's actually the one that's going to govern, but it should absolutely match. One of my pet peeves, Jeremy, these days has been the sometimes ridiculous amount of co-GPs that are on a particular sponsor team. Any thoughts on that? Is there a limit to how many, like if there's 23 co-sponsors, is that a problem? Or what's the number that you like to cut off?
Look, to be honest with you, I rarely see that happening in deals I'm investing in, because those tend to be with more the newer sponsors who are having trouble raising capital or new and need that help raising capital. So I'm not really dealing with that equation or decision very often. I would imagine if I saw more than one or two or three, that would be a huge red flag. And I don't mean a red flag in a bad way. I mean, then you have to start to dig into like, okay, do they have any control provisions? What are their voting? Are they going to have, between the three groups, are they going to have majority vote on the LP side? And now what's that mean for my vote, right? So there are potentially implications to having a lot of co-GPs, but I think the first thing to really dig into is like, what exactly does that mean? What control do they have? What rights do they have? Can they take stuff over? Are they going to be riding the bus if something goes wrong? And who are they, right? Because I'm making a bet on certain people, and I'm trying to figure out who they are. And if there's now more cooks in the kitchen I wasn't even aware of, or I should be aware of, that changes the dynamic of the due diligence I have to do.
Do you demand that the GPs put in some percentage of the deal money themselves?
Yeah. So I know this is very subjective. I don't have a hard requirement for that. I have a strong preference for it. And where I make exceptions is with those very, very experienced sponsors, and especially those who are buying very large properties and a lot of volume of them, right? And so good example, I've invested in the past with the top 20 self-storage operator in the US. And like at any given time, they could be acquiring literally 100, 200, $250 million of properties. And, let's say in the course of the next few months. And I've asked them about this before, because they don't necessarily co-invest in every single deal. And they say, look, I have millions of dollars tied up in all of these earnest deposits and other things. And so there's a point at which, in my opinion, an LP needs to kind of factor that in. Is that reasonable, and a reasonable reason why there isn't a co-invest in every single deal? But most importantly, for any of this stuff as an LP, you have to be 100% comfortable before, as soon as you give your money, you're giving someone else control. So I am comfortable with making the odd exception, but I think there are a lot of LPs who aren't. And maybe they won't be investing in that type of sponsor.
Do you count the acquisition fee when making that calculation? I mean, if I put
No.
in, no, so if I take a 2% acquisition fee and I put 100% of that into the deal, do you not count that when you're trying to figure out this number?
I'm okay with that for the same reason I just mentioned. It's because someone's going to have a little amount of capital. Now, there's a very different equation if you have 5 deals under your belt and you haven't bought that much. And, again, it's different equations. I'm usually dealing with more experienced sponsors who are more inclined to have that type of challenge.
Final question, then I'll let you go. And exit cap rates. I think generally in the old days anyway, 12, 18 months ago, I think, having a lower cap rate as an exit cap rate was problematic. I have a sense you're going to start seeing some of these as prices keep going lower and lower, and then they start bottoming out. Would that be a red flag for you, or how do you consider exit? If the exit cap rate starts to look, higher than, or if the exit cap rate is now lower than your entry, and because they're basically assuming the prices are going to go up, what are your thoughts on that?
Yeah, so keep in mind, for the type of deal I invest in, I'm looking for that more stabilized cash flow. The upside is not as important to me, if just not even there at all necessarily, like in the business plan. So for the type of stuff I target, I still want to see someone who's assuming an increased cap rate to exit, because they're not trying to target into a specific IRR, some important value add, return piece. And so for me, even if people think we're at a bottom, I'm still going to be looking for that increased cap rate, because I'm looking for someone who's conservative. And even if we are at a bottom, someone who's conservative is still going to underwrite the same way, in my opinion.
Awesome. Well, Jeremy, thanks for a world chock full of great nuggets and information. Really appreciate you. Where do people find you? I know I think you've got a group. Like I actually was looking for you. I know you're on LinkedIn. What's the best way people can find you?
Yeah, so there's really only 2 ways. I don't have a website. I'm not on social media. I'm not on anything like that. So I'm very much to myself. But 2 ways. One is you can find me on LinkedIn. I don't post or anything like that, but my profile's up there. And you can also email me directly, which is jroll, JROLL, at @rollinvestments.com. And that's plural. So jroll at rollinvestments.com. You can use either of those two.
If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.